Before we begin today's video, I would like to ask you a question. Are you the type of person who goes into particular brands, quality, underlying stuff, what are the ingredients, and so on and so forth before making the decision to buy a product? Or would you prefer to buy something which is from a decent brand and available at a good sale? Which one are you? Hi friends, in today's video we'll talk about different styles of investing in equity and equity related mutual funds. If you are investing right now, chances are your investment style either falls under growth or value or maybe a combination of both. Let's find out. Growth investing versus value investing. Both are a part of the same fundamental school of investing, but both are radically different in their approach towards stock selection. The first factor to consider is the growth of the underlying company. This is one of the most important factors for growth investing. So what do we mean when we say high growth? We mean that the sales and the profitability of the company increases year after year on a consistent basis. Usually, smaller and younger companies exhibit higher growth rate. However, it is not a monopoly of only smaller companies to exhibit high growth rates. Several large companies like HDFC Bank, Asian Paints, ITC, Marico, Nestle have also exhibited very high growth rates consistently over the last several years. The second important criteria is valuations. When we say valuations, we are talking about the price that other investors or the prospective buyers of a company's stock are willing to pay. Stock prices and intrinsic value of a share often differ. Value investors typically buy stocks at a price much lower to their intrinsic value. They hold the stock till the time price increases to the intrinsic value of the stock. Despite strong fundamentals, value stocks are often out of favor with the market. This could be due to several factors. There could be some changes in the regulations, there could be a problem with the major supplier, distributor, or customer base. And if we see these problems solving them in the near future, the prices of the company stocks may go up once again. There are several ways in which we can judge the valuations. Two popular ratios in this regard are price earning and price book. Let's talk about price earning first. Price earning ratio or price to earning ratio is a ratio which measures the amount an investor is willing to pay for 1 rupee of earning of the company. Please note that the price is to be paid once, whereas the earnings will continue year on year, which is why the multiple could be very high. Next we come to price to book ratio. Price to book ratio is the ratio of the current market price of the stock versus the book value of the stock. This ratio is more relevant for financial industry where the book value of the assets are closer to their market value. Again, the share may trade at several times the book value because number one, the price of the assets may not be properly reflected by the book value, as book value typically reflects the purchase price less the depreciation. Second, we are not buying the assets here, but what we are buying is the cash flows which these assets will generate for us. Since the cash flows would come in future and at the best we can arrive at an estimate, the values at the present may be discounted. So how does price earning or price book help us understand valuations? Well, if a stock is trading at lower price earning or price book vis-a-vis its peers or its own past record, then we can say that it is trading at a lower valuations. But this is just a starting point and we need to investigate further to evaluate whether it is a good buy or not. Value investors usually buy the stocks at low valuations with the expectations that they will make money when the prices again reconcile with the intrinsic value. Even in cases where the stock prices may not go up in near future, the investors are safeguarded because they have made these purchases at significant margin of safety. On the other hand, in case of growth stocks, the valuations are relatively more expensive because a larger chunk of growth is also factored in while considering the price today. Going forward as well, the growth stocks have to continue showing an increase in sales as well as profit so that they can justify the premium which the investor is paying for them today. In case they are not able to generate this growth, then the stock prices may see a decline and an investor in such cases may also incur losses. In case of value stocks, however, A value buy may someday turn into a value trap, whereby the stock prices, instead of increasing further, may just keep on going down till the time the company goes bankrupt or is being taken over by somebody else. That's it in this video. But before we close this video, let me just take you back to the first example which we took. In case you are looking at certain brands and trying to buy those, you would be closer to what we call a growth approach in the market. However, in case you're buying clothes at sale, you would be closer to a value investor. Hope that clarifies things. If you haven't subscribed to the channel yet, here's your chance to do that. If you enjoyed this video, do like it and share your feedback or questions in comments. Thank you. Bye.